So the good news, I guess, is for the first year in a long time, nothing's really changed since last year. So if you want to leave and watch last year's video, you're all set. No, I'm kidding. There'll be a little bit of change, but honestly, not much has changed, which I think is Phil for the first time in a little while that we haven't had a bunch of changes. So what I think we want to do is start with basic corporate structure, go through your types of structures. I'll layer in a little bit of tax and accounting, then Phil will go into that in detail, and then we'll come back for some regulatory issues to look out for. Again, this is mostly aimed at proprietary trading firms, but the one thing to be careful about, which we'll get into, is from a regulatory perspective, a prop firm that looks like a prop firm, you add a passive investor here or there and you start to look like a hedge fund. So a lot of the regulation that you think doesn't apply to you as a prop firm can creep in. So for the most part, we're going to really focus on prop firms from a setup perspective. But when we get into regulations, I'll talk a little bit about how you can move from potentially to, for the most part, an unregulated prop firm over to a regulated asset manager. So I think the first thing we want to talk about is structure. So, let's say you're a trader and you want to start trading. There's a couple easy ways to do that, a couple hard ways. The first is most people think, oh, I'm a trader, I'll just go ahead and open up a trading account and that'll be fine. And so you'll sign your documents with Advantage as an individual, which Advantage likes. Problem with that is you have no limited liability. So if you sign as an individual, you're sort of personally liable for everything that happens to that account. So what clients often do is they'll sort of say, all right, well, I want to use an entity instead. And so the question will be, what's the choice of entity? And usually the types of choices are corporations, S corporations, LLCs, LPs. Back in the day, people did C corps and S corps because that's what they were used to. A C corporation is really something you're not going to be interested in because it's a corporation that's taxed as a corporation, which for you simplistically means a double layer of tax. And so I would think of that as tax inefficient. So there's going to be very limited circumstances where anybody's going to ever want to use a C corporation. The other option is an S corporation, which people used often years ago. And before LLCs came out, people liked S corporations because they were corporate they were actually limited liability from a corporate perspective. So you actually had limited liability, but they were taxed as a partnership. So it appeared to give the benefit of both. The downside of S corps is they're highly limited in who can be a shareholder of an S corp and how complicated you can get from your allocations. So to remain an S corp, basically you have to have, for the most part, individual owners. So if you ever decided I'm a prop firm and Phil and I start out, we start the prop firm, but later we say, Phil, we need more money, let's go get an entity or an institution to give us money. Now that you would, in effect, invalidate the S corp. So for the most part, we don't really like using S corps just because they seem fine now, and in the future they cause us problems because they're limited. So usually the next question will be, well, do we form an LLP, or an LP, or an LLC? LLCs and LPs are similar from a tax perspective in that they're all flow-through entities, meaning unlike the corporation, there's no corporate layer of tax plus a personal layer of tax. They're flow-through treatment. So for many of you that trade futures, you probably know about 60-40 treatment. You probably know that actually, which Phil will go into detail, has beneficial tax treatment. LLCs and LPs allow you to retain the character of that treatment as it flows through to you. So the real difference between the structures is one, tax, which I'll get to in a second, and two, from a corporate perspective. An LLC we use the most. And the reason is you get flow-through tax treatment, but you have limited liability. So if Phil and I are members of an LLC, we as the managing members, or even if we were both managers, by statute have limited liability. So if something happens to the firm and it runs out of money, technically, except for very limited circumstances, they can't look through to us. An LP, on the other hand, you have to have a general partner of a limited partnership. And a general partner by statute has unlimited liability. So if Phil and I formed an LP and one of us was the GP, that person would literally be liable for all the debts of the partnership. So what we then would do typically if we decided to form an LP is we would have to form another entity to be the general partner. That entity would typically be an LLC, so that in effect you have a limited liability entity between the general partner and the partnership. There is, and I'll one benefit sometimes to limited partnerships from a tax perspective. It used to be more prevalent in the prop industry where you guys are subject to self-employment tax, and before Obamacare came into play, using a limited partnership used to be able to shield you from a fair amount of self-employment tax. With Obamacare now, which again Phil will get into, for the most part trading profits, you can't really use an LP to shield self-employment taxes. But hedge funds, just so you know, where they're still receiving management fee, there still is a potential tax benefit of using a limited partnership if you ever have a hedge fund or ever manage someone else's money and get a management fee. But for the most part, we're going to use LLCs. And the main benefit also of an LLC, as opposed to an S Corp, is besides the lack of limitations on having owners. We can have owners of their entities. We can have as many classes you can think of. We can allocate P&L, by account, by trading group. We can do it based on sale profits. We can do it based on other types of businesses. The main benefit is that you can issue a profits interest to somebody. And so what is that? What is a profits interest? It's really if Phil puts all the money into the firm and I'm the trader and I'm the one who's going to generate the profits, and Phil says, I want to give you 50% of the firm. If we did an S Corp, I'd have a problem because I'd probably have a taxable event. But in LLC, he can give me what is in effect a carried interest where I can get 50% of future profits as well as 50% if we ever generate enough income to actually sell the firm. I can get capital gains on my sale go forward. That you can do in LLC and an LP. You can't do that in an S Corp. So many traders who, they start the firm for themselves, they usually capitalize it. But then when they bring in other traders who, are successful and basically figure out, hey, I'd much rather have the 60-40 treatment than ordinary income as a W-2 employee, they start to ask Phil and I, hey, can I get a piece of the allocation? And in an LLC, you can structure that. So that's the main benefit. Usually so those are really your structures. Usually the next questions are, if I'm going to form an entity, let's say it's an LLC, where am I going to form it? Most people in Illinois will lean, because in Illinois I might as well form an Illinois LLC. We don't like using Illinois LLCs because we like using Delaware. And the main reason for that is Delaware in effect allows you by statute to craft your deal with very limited default provisions. So in Delaware you can, for the most part, contract away all duties or customize duties between the members and get rid of fiduciary duties. Whereas in Illinois, no matter what you do, managers have fiduciary duties. So if you're the principal of a firm and you start your firm, and then you want to, as I mentioned, bring in a trader to get a piece of in effect, their compensation on a K-1, the last thing you want to do for that good deed is then open yourself up to claims for fiduciary duties. Delaware will allow us to limit your exposure to those claims. Illinois will not. So even though it sounds like if you're in Illinois, you form an Illinois LLC, we almost never form Illinois LLCs for that reason. The other question, once you figure out, all right, maybe I have an LLC in Delaware, it's for trading, is at the end of the analysis. And often for a startup firm it is. But as we get more complicated, we tend to start to think about taking our various assets and liabilities and separating them in a means to protect one asset from the other asset, or have one liability not spill over to the other. So to give you an example, if I had set up a broker-dealer to trade equities, and I'm regulated as a broker-dealer, and then I decide I want to trade futures in an unregulated manner, we would typically suggest setting up two entities. Under the theory that if I'm doing futures trading, there's no reason to have that in a broker-dealer where A, it's regulated by the SEC and whoever the designated examining authority, but that broker-dealer will typically have net capital requirements, and futures will actually hurt that net capital. So usually we'll separate them so that the futures is done in sort of a non-regulated, non-capital computing entity, and the securities is done in the broker-dealer. Now obviously that assumes that you have enough capital where you can separately margin the two, but it's probably more advanced, but there are also ways to cross-margin the two, even by separating them. The other sort of next step we do is we'll take, if you're an algorithmic trader and you're developing a lot of intellectual property and software, we also would rather not commingle that software with the trading. So for instance, if hypothetically the equity blew up, we wouldn't want the IP to go down with it, And if we got a claim on our IP, we wouldn't want them to be able to attack the trading capital. So we usually set up an intellectual property company. And now you're saying, well, I got all these companies, how do they fit together? Often we'll then form a holding company where the partners are in the holding company and then they own the various entities. So we can create as many entities as possible, but usually the question is, at what point do I have diminishing returns? Because every time I separate it, I create more complexity, and it drives the finance people a little crazy. So what we're usually always looking at, is it worth the separation and the complexity to sort of gain a little bit in protection. So I think that's sort of a basic overview of the type of structures. Now Phil will go into a little more detail in sort of tax analysis.
Let me just follow up on a couple of Lance's points. The structure that Lance mentioned about the holding company and the 2 or 3 subsidiaries, the trading subsidiary, as they're all 100% owned by the holding company, they're disregarded entities for taxes, meaning that a one-member LLC does not file a separate tax return. It's included in the tax return of its one member. And that would be the same for an individual. If an individual sets up an LLC where he or she is the only member, for tax purposes, not for liability purposes, that entity is a disregarded entity. And so there's no separate tax return for that entity, that the income or expense from that enterprise or activity is just included in the individual return of the one member. And let's assume, just for the presentation this afternoon in terms of taxes, is that we've eliminated C Corps because there's no benefit of capital gains in C Corps. We hardly ever see subchapter S entities anymore. I mean, there's no reason to have them. As Lance mentioned, from a tax standpoint, they're very difficult to deal with.
So people used to use them though, right? They used to have play a little bit of, there was a little play in deductibility, right? But people don't really do that anymore.
There was that, not so much in the trading entity, Lance, but you saw floor brokers who would set up sub-S corporations, and they would pay themselves a salary, and the difference between what they took out and their salary was not subject to FICA, and if you own the sub-S, you're paying both the employer and employee portion, which is about 15.3%. But as Lance mentioned, with Obamacare tax now, you're going to pay it anyway. So having said that, let's just talk about first trading income and then expenses. And by trading income, I basically mean the gross gain or loss from where you buy a financial instrument and where you sell it, less the commissions, exchange fees, clearing fees. If that income is from regulated futures contracts, which are futures and options on futures traded in a domestic exchange, or one of the 5 foreign exchanges which are defined as regulated or designated futures exchanges, by definition, 60% of the gain is long-term and 40% is short-term. The exchanges outside of the U.S. which qualify for 60/40 treatment are Bermuda, Montreal, Cymex Offset, the ICE, Dubai, Life, and the most recent one, Eurex. Section 1256, which basically created the 60/40 tax treatment, was passed in the 1981 Tax Act, and then it was expanded in '83 to equity options. And basically, if you can think about it, you know, if you're a trader, a trading entity, you have 2 baskets of income. You have the 60% which is long-term and the 40% which is short-term. assuming that you're defined as a trader if you're an individual, or a trading entity if you're a LLC or an LP or a general partnership, that your expenses are all ordinary and they all go against the 40%. The tax on long-term capital gains is 15% up to $450,000 if you're married, and then it goes up at 20%. And the top individual rate on short-term is 39.6%. So basically what you have is that you have a blended rate of 28% before either self-employment tax or Obamacare tax. But let's go back to this two separate buckets. At the long term, 60% of the gross, and the short term, 40% of the gross. And what you have are all your ordinary expenses against the 40% of the gross, which would be trading technologies, quote expense, if you're leasing a membership, seat lease, technology cost, quote equipment. And if you have employees, the employee expense. In most mature, successful trading entities, those ordinary expenses more than offset the 40% short-term gross gain. So what's the result? The result is that your marginal tax rate before Obamacare is either 15% or 20%. It's the best deal of any industry I know of. That having said that let's talk about what's composed in 1256, or what it's made up of. As I talked about regulated futures contracts, if you're trading in a market maker account at the CBOE, then your equity options income would be 1256. If you're anyone and you trade broad-based indexes, OEX for example, that's 60/40. If you trade currency forwards and the same currency is traded at the IMM, that's also 60/40.
But to be clear, Phil, the big difference between futures and options, equity options, is you have to be a market maker, right? You have to be
it has to be traded in a market maker account.
And you have to be active.
Correct.
Whereas everybody on futures, every owner, whether passive or active, can take the flow through. Whereas on equity options, first you have to be market making, and then only the active people can take it. The passives can't. So obviously, the futures people got the better deal.
They did. But then again, the law was passed earlier.
Right.
And the last product, which makes up 1256, are stock futures, or futures on individual stocks for a trading professional, which usually means either a market maker or a member of an exchange, if it's traded on a futures exchange. The other unique area of Section 1256 products is it's the only type of capital loss which you can carry back. So if you were to have a loss 1 year, you could carry it back 3 years, 2 years, and 1 year, but only against 1256 products. So say, for example, that in 2011 you made money, and in 2014 you had a loss in the futures, you could carry that 14 loss back to 2011. Now, sometimes that's good, sometimes it's bad. As you know, the tax rates went up in 2013, so that it's an analysis that one would do if they had a losing year, coupled with that how most people would look at it was if 2014 was a loss year, they may want to extend their tax return until October and see what their 2015 trading activity is before they elect to carry it back. In many cases, you see a 1256 item traded in conjunction with a non-Section 1256 item. The best example of that is trading a U.S. Treasury bond future against cash U.S. government securities. And basically, if the mixed straddle election is made, what you can do is look at both those products together. And if you mark them to market every day, record that activity on a daily basis, you would aggregate it at year end. If the gain was on the future side or the derivative side, and there was a loss on the cash side, your net income would be taxed 50% long-term and 50% short-term. If your gain was on the cash side and you had a loss on the future side, then that gain is taxed at whatever the ordinary rate is, up to 39.6%. Another area where you'd see mixed straddles would be if you're trading in a market maker account. Most market makers trading equity options are also trading the underlying stock. And the underlying stock would be the non-Section 1256 product. The next item I'd like to touch on is a 475 election. A 475 election does not make a lot of sense for regulated futures contracts or Section 1256 products, but a trader just trading equities and never holding those equities very long would find it appealing, because you're not going to generate long-term capital gains anyway, and the accounting for it makes it easy. The gain or loss is also ordinary, and as an ordinary loss you could carry it back, or as an ordinary loss it would offset other ordinary income. As opposed to capital gains, whether they're long or short-term capital gains, you can only deduct them to the extent of $3,000 in excess of capital losses. The determination of whether someone's a trader or just an investor is important, not so much for the treatment of the income, but the treatment of the expenses. If someone's a trader, they can deduct their regular expenses before AGI. If it's an individual, it would be on Schedule C of your individual return. If you're a partnership, it would just be the ordinary expenses on the partnership return, which, as Lance mentioned, is a flow-through entity, and it flows through to the individual. What determines a trader versus an investor is the frequency of the trading, the objective of the trading, the regularity of the trading, and the resulting character of the income. Chances are, if someone buys stock and holds it and generates long-term capital gains and dividends, the IRS would really not term him a trader. In fact, the most recent tax case that came down was in 2013. The court looked at the number of trades and the frequency of trading, that the taxpayer had traded roughly 300 times one year and 500 times the next, and the court said that that certainly wasn't a trader, coupled with 48% of the business days of a year he traded, and they maintained that was not a trader, that he was an investor. As an investor, your expenses related to trading have to be taken on Schedule A as a miscellaneous deduction. As a miscellaneous deduction, you can only deduct them in excess of 2% of adjusted gross, but what you don't lose there's a good chance you'll lose if you're in an alternative minimum tax situation, because you lose your miscellaneous itemized deductions. Another area, in fact, we talked about this last year, was that if you're a trading entity, how do you pay your traders? Okay. That if they're employees, they receive a W-2 and they're paid through the payroll system. as Lance will talk about when he talks about exchange fees, if that particular trader becomes a member of the LLC or a partner of a limited partnership or general partnership, then he receives a K-1. And given that he complies with the MERC requirements, he can have the benefit of the 60/40 treatment of the income. There's some firms out there that would pay their traders as independent contractors, and instead of a W-2 or K-1, they would receive what's called a 1099-L, and they would be termed independent contractors. The IRS looks very closely at the issue of employee versus independent contractor. And basically, they have a 20-factor test. And it's very much focused on control. And I like to use these two examples of someone that, or a trader that the IRS would term an employee, and a trader that the IRS would say is truly self-employed, independent contractor. The trading firm adds a trader. They make him sign a covenant not to compete, usually a trading agreement. He has to use their software for entering trades, and they certainly give him the trading limits. They tell him that where he can trade, where he can clear, and basically that they're giving him the rules under which he trades. That person would be designated by the IRS an employee, as opposed to another type of trader who trades for 3 or 4 different firms and uses his own strategy that the firm that's retaining him could certainly allocate him capital or give him position limits, but he can leave tomorrow and trade for whoever else he wants. And that would be a good example of a true independent contractor. The last item we'll talk about is there anything on the horizon that gives us concern? That as I was preparing for the presentation this afternoon, I realized there was no major tax legislation in the last year. I find it doubtful that there will be this year. There's a lot of talk of tax reform, but given the situation we have in Congress, I find it highly unlikely. For all of us in this room, this is good. Again, that the 60/40 concept is always under attack. In every one of the president's budgets that he has sent to Congress, he has suggested doing away with Section 1256, making the income ordinary income and keeping the mark-to-market aspect of 1256. As Lance mentioned, carried interest is an issue that just keeps coming up. Luckily, it doesn't go anyplace. We're concerned about carried interest because the trader I just mentioned, the one that goes to his employers and says, gee guys, you've been sharing in this 60/40 for 3 years, I've been making money for you, now I want to share in that, I'd like to become a partner. Carried interest basically is where someone is being allocated profit in some regard other than his percentage of capital. How Congress would attack carried interest is they would say, if you're allocating the different characters of income, and most especially long-term capital gains, you have to do it proportionately in terms of everyone's capital account. So if you think about it, a large trading entity or a trading entity that had different classes of partners, and I like to call them Class A, Class B, Class C. Class A are usually the capital partners that they receive a certain percentage of the trading profit, which is less than their proportionate share based on capital. Where the Class B partner, we'll say, is the actual trader, he has a minimum of $250 up if the firm is a CME member, but he's receiving a larger percentage of that trading income than his capital contribution would warrant. And that's really it. So I think Lance now is going to talk about exchange fees, which he's the foremost expert.
Much to the CME's chagrin. Phil mentioned a lot of our trading firms, there's two things they want to preserve: tax treatment 60/40 and CME member rates. Often those things are in conflict with each other because the CME has, I'm sure you've seen their June, a couple years ago, fee policy bulletin. It's pretty thick. There's a lot of rules about how you set up a firm and what you can do and still keep member rates. And the primary concern of the CME is they don't want firms to be able to sell their rates. So what they don't like, and we'll get into this for regulatory purposes, are arcades. Trading arcades is a very bad word for them, two bad words. And so their rules are set up to make it difficult for firms to set up for the sole purpose of giving their rates away. So firms that sort of go ahead, they buy the memberships, and their sole purpose is there to give the rates away. On the equity side, it's more prevalent, although it's a different regulatory issue, where you'll hear of these firms that you come in, you trade, and somehow you get 100% of your profits back. And I don't know many of my clients that make money if they give 100% of the profits to the trader. So on the equity side, you see it more. I'll get into it's a big regulatory issue there. But on the future side, it's primarily a CME issue. And so, the basic concept again is, let's assume we have a trading firm. How do I become a CME member? And CME has changed their rules over time, but most recently, about 2 years ago, they had a stock split. So I remembered all the numbers as to how many shares I needed, and now they all changed. But for the most part, there are now 20,000. This is for a member firm, an entity, 20,000 shares for one exchange, and then 30,000 for two and 40,000 so for three. So what they give you is you have 20,000 on the first exchange. If you want to add, they're one of the CME, CBOT, or NYMEX, you get a break on 10,000. And then they have sort of different levels where if you're CBOT member and you're a prop firm, they tend to only require one membership. Whereas if you're on the CME and you want to be a member firm, they require 7 membership. And NYMEX has its own special rules of 2 memberships. We won't get into NYMEX as much. But let's assume first we become what's typically now known as a corporate equity member, or a 106J, which is the highest level of firm that you can be at the CME, meaning the lowest level of rates. Now you want to set up your trading accounts, and you want to bring in traders, and you'll see there's all these rules about how you compensate your traders, and your first probably thought was, why does the CME care how I compensate my traders? Why do they care if I give them 90% of the profits? Why do they care if I give them a K1? Why do they care if I charge a little bit on top? And again, the reason they care is they want to make sure that you're not indirectly selling their rates to the members. So generally speaking, on a member account, if you have an employee, you're in good shape, as long as you don't give the employee more than 80% of the P&L. And if you have a team, you can't give the team more than 80% of the P&L. Now, the one thing that you should know, because it's not clear in the rules, is the P and the L don't need to be the same. So you can have a situation where you can have 50% of the profits and 80% of the losses, or vice versa. They don't have to actually match, so long as neither goes above 80. So generally speaking, what the CME will look at is their rules will depend on how you characterize. So as Phil said, the 3 typical categories for a trader: W-2, 1099 miss, and a K1. Now you'll also hear people issuing 1099Bs, which is sort of another way to try and get 60/40 treatment to traders. The CME will view a 1099B effectively the same as a K1. Do you guys see a lot of 1099Bs, or mostly you're deferring to K1s?
K1s.
Yeah.
The problem we see with the 1099B is if you're a trading firm and you issue one could maintain that you're an FCM.
Right.
That we do see them in terms of joint accounts, where Lance and I'll have a joint account at Advantage, but Advantage will only require one social security number. So at year end, let's say I would get the 1099 under my social security number and I would give Lance a 1099B. But the idea of a trading firm giving an individual a 1099B, I believe is pretty risky, because I believe a regulator can come back and say, well, if you're giving someone a 1099B, that's analogous to carrying a customer account.
So yeah, we don't see a lot of it, but the CME, because they're focused on the tax treatment, will equate a 1099B with a K1. So again, if you have W-2s and 1099 misses, and miscellaneous is important because it's ordinary income, the CME's rules are less complex. They basically look at the 80% rule, and then they have all these other rules, which, again, if you look at the rules, they're trying to get at, are you acting like an FCM as opposed to a prop firm? So the things they prohibit are, you can't charge more than your cost, with an exception, which I'll get to. You can't make money on the fees, because that's called a broker. An Advantage has a lot of licenses to be able to permit it to charge a commission. But a prop firm cannot do that, not only for CME purposes, but again, we'll get into it in a second, they can't do it for regulatory purposes, because as Phil said, they start to look like an FCM. That's how an FCM or an IB make money. They charge commissions, and Advantage will tell you how complex it is to be an FCM. There's a lot of regulations around that activity. So from a CME's perspective, though, they're looking at, are you a prop firm? They're not really necessarily as focused on the FCM issue. They're focused on, are you a prop firm, and do you properly have our fees? But then you get into the 60-40 treatment. So we bring in somebody as a K1. And to the CME, bringing in K1s really concerns them, because now they're looking at, so now you can get in effect the member rates, and you could give the tax treatment. And so they start to think that, wow, now there's a lot of slippage, because we can see people pulling all these K1s and giving people, in effect, almost the same deal that they would have if they had their own firm, but really become within a firm within a firm. So they have two sets of rules. One is, I would call individual, eat what you kill trading, and the other one is team trading. The first is, if Phil and I hire a trader, bring him in as a K1, and that person only trades their own account, and they're getting a K1 for their own trading, then the CME says, all right, that person has to have $250,000 of capital, and we have to abide by all these other rules, not charging, not making money, but that's sort of the end of the analysis for the most part. If, however, Phil and I hire two people, and the two people trade as a team, and their P&L is based on their joint account, well, now we have what the CME would call team trading, and that really concerns the CME, because that's where the slippage will become a firm within a firm. Because once I have two people trading together, why not have 50 people trading together? Why not Phil and I start a firm and just go have all these other firms join us, and then we all can sort of use one set of rates? So what the CME has done to combat that is say, not only does the trader get a piece of their own P&L, the team gets their own P&L, but to make it difficult, now the team has to get a piece of the overall P&L of the firm, generally based on their capital over firm capital. So you can imagine for the firm, who would rather just give the trader their P&L, that becomes a big problem, because if the firm has to give a piece of the overall P&L, the firm will be in a situation where if the trader is, let's call it flat or negative, that trader's still getting a piece of the firm's profits. And so they've made it more difficult to do that. But that's the rule. I will tell you that there's not a lot of people who fully understand the rule, because it's not necessarily as clear as it could be, but that's the rule. And what's a team becomes a little bit of an analysis, because if Phil and I are both active traders and we trade together, they'll view us as a team. But if Phil's the active trader, I'm just a clerk and I'm an assistant, and I'm performing more clerical administrative duties, and I'm really getting a base and discretionary bonus, then they may view that as a non-team. But that line between that fact scenario and the other fact scenario can be very gray. So I would be very careful with the CME rules if there's more than one person trading the account. Now this is different than, you know, Phil and I and another person, we all put a third of the money in, and we're all sort of own the firm, and our percentage is not based on just what I do, but it's based on the whole firm. That they don't view as team trading. So to give you an example, if I brought a trader in, instead of saying I'm going to give you a piece of your P&L, I just say, you know, listen, I want you to be a partner, I'm going to give you 3% of the firm. That's not team trading. That doesn't even implicate the CME rules because it's not a situation where their P&L is based on their activities. They're a partner of the overall firm, and so it shouldn't impact CME rules. Now, the one thing I caution you on is they still will look at it, because what they're concerned about, which I've had them look at before, is so in these small numbers of 2%, 3%, that makes sense to them. It looks like equity incentive compensation. But they start seeing like, oh, you're giving the trader 40% of the firm. Well, that starts to look something like maybe you're just doing that to give them 40% of the P&L. And really most of the trading profit is attributable to that trader, and it's an indirect way to, in effect, give a trading deal. So they'll look at it, and you have to be careful. But for the most part, if it looks like traditional equity incentive compensation, that won't really implicate their rules. There's a lot of other CME rules. I don't want to go over all of them or I would bore you to death. But the one thing to note is the firm, I said the firm can't make money on upcharging the commissions. That's true. But the limited exception where the firm can charge more than the actual cost is where they're recouping expenses. So you are permitted to recoup your expenses. So if we have traders that are, let's call them high-frequency traders, a lot of infrastructure, a lot of data, a lot of software, very high technology costs, I'm allowed to recoup those costs. The two main ways to do that are I figure out my overall, I look at their volume, and I allocate on a rational basis overhead against their P&L. That's one way to do it. The other way is to do it based on upcharging the commission. So I say, hey, I'm charging you, you know, our cost is 12 cents, I'm going to charge 15. Okay, because that's my estimate of that 3 cents based on your volume I think I'll recoup. Now the CME will give you a little leeway to get that right, and it doesn't have to be perfect, but to do it that way, you do have to go back and make sure that when you charge that 3 cents, you're not making money. In other words, you're only recouping, or a lot of my clients don't even come close to recouping. But if you look at the end of the year that you're making money, you need to change it and lower it. Because they will look at that closely, because obviously that's the thing they're concerned about, which is non-registered firms making money off commissions so that they're not regulated to do. So that's the CME's concern. Let's talk about the SEC and the CFTC's concern. Their concern, as I alluded to, is that you're really running a customer business without being registered as such. And for a while, people talked about it. There wasn't much out there. We were saying, hey, it's common sense. Advantage is regulated. You're not. Doesn't seem like you should be able to do the same thing as Advantage. But for a while, people were like, there's never been anything out there. You know, you guys are just conservative. Don't worry about it. And then we have a case called Tuco, where the SEC finally said, yeah, that looks like a customer business. How are your prop traders getting 100% of their P&L? How can you guys make money if you give all the trading P&L away? And lo and behold, they were basically making money off the commissions. And so there's a line of cases where now the SEC is active in it. They look at it. And not only did they go after the trading firms, but now they went after the clearing firms for aiding and abetting. And so the clearing firms are now worried about aiding and abetting a prop firm. So the clearing firms all went through their clients, looked at their documents, and made sure that they looked like bona fide trading firms as opposed to disguised FCMs or IBs. And you saw a lot of play on this on the equity side because you didn't have almost the CME over top. Because for the most part, if you follow the CME rules for membership, you're pretty much going to be sure you're not worried about being an FCM. So most firms are already CME, and we didn't worry about it as much on the future side. But on the equity side, it's not really a fee play, it's a leverage play, right? So back in the day, it used to be to get leverage, I needed to be a JBO. Well, Phil and I didn't want to form a broker-dealer. That's not fun. So we would find another broker-dealer, and we would go through that broker-dealer. That broker-dealer was a JBO, and they would give us leverage. Okay, and there's a lot of firms that gave us 100% of our P&L back. Then, as we got portfolio margining, and although you didn't need to be a broker-dealer, instead of being at the $1 million level to be a fully engaged portfolio manager, now you're at 5 million. So you saw even more arcades pop up because 5 million was an even bigger number. And so on that side, the SIBO got involved, FINRA got involved with all these circulars, finally waking up to the fact that we need to look at these master sub-account arrangements and make sure that they are indicative of a bona fide proprietary trading relationship and not a customer. So that is really, for most prop firms that are truly trading as prop, this isn't an issue. But we do represent a lot of firms that do have a lot of traders with individualized deals. And you have to be careful about those individualized deals, again, looking like customers. So that's one side of the regulatory issue. The other side, which I'll go through quickly, is this idea of moving over from being a prop firm to an asset manager. And a lot of my clients want to become an asset manager. They just don't want to unwittingly do it. They want to know what they're doing. So for the most part, proprietary trading firms, and let's sort of set up the most conservative example. Proprietary trading firms where the only owners of the firm are active traders. Okay, and I'll use traders. They could be active compliance people. They could be executives. They could be finance people. But let's just go with this simple version of 3 traders. They're all active. For the most part, whether you're trading equities or futures, it's the one last place where you're almost completely unregulated. You're not really regulated with the SEC because for the most part, you'd argue you're not an investment advisor. You're not providing advice. 3 traders coming together aren't really providing advice to each other. You're not a CTA under the same theory. You're not providing advice. You're not well, you might be an investment company, a hedge fund, but there's exemptions if we're under 100 people. We're exempt as registering as an investment company. And then the big one on the future side is, are we a pool? And if we're a commodity pool, then we have to register as a commodity pool operator. And so commodity pool is a fancy definition in the Act, but it's basically in the nature of investment trust, syndicate, or similar form of enterprise formed for the purpose of trading futures. So that doesn't help us out a lot on what that means, right? Because you could argue, hey, if the 3 of us put money in, are we an investment? What is an investment trust? Are we that? We're clearly formed for the purpose of trading futures, but are we an investment trust? So there was a lot of debate because the CFTC used to see anybody. They loved to see everybody as being a pool. But then that was challenged. And basically what the court cases came back, and they're sort of, the precedent's a little bit all over the place, but for the most part, if you are active, then it's hard to see any 3 active people forming an investment trust or syndicate. What they're really looking for with those words are a traditional fund. I'm a passive investor. I'm putting my money in, and I'm relying on Phil to trade and make money. I have no real active role. I'm just putting money in and hoping Phil makes me money. That is a pool. The problem with the analysis is there's not that much out there on this. There's a couple CFTC no action letters. Those no action letters are not that helpful because those no action letters are on the best of circumstances where not only did Phil and I, are we active, but we somehow, I guess I didn't advise them, we were general partners too. And so they have the facts that are, of course, that's obviously not a pool. So what you tended to see was if someone brought in a backer, as you start bringing in backers or anybody passive, there starts to be a risk that you're a pool. And back before 2012, there was an exemption under the CFTC regs where, oh, we fit within the exemption. We're all accredited investors, or we're all qualified eligible persons, and we can just file an exemption, not even worry about it. We may not be a pool, but since we have a clear exemption, let's just go file that exemption, not worry about it. Because an exemption's pretty black and white. Taking the other approach, which is I don't think I'm a pool, is more qualitative, right? I have to make a qualitative determination whether I fit in these facts without a whole lot of specific precedent. So a lot of our clients would go file that, well, not a lot of our clients, a lot of people would go file that exemption. Well, then in 2012, the CFTC rescinded the exemption. And they really rescinded the exemption. They had no care in the world for prop firms. They were doing it because they wanted to get all the hedge fund advisors registered, because before that, the SEC also changed their rules to get all the SEC hedge fund advisors to register. So the CFTC, once they see the SEC do that, they don't want to be left out in the cold. So they go and change their rules to also require commodity pool advisors to, or operators to register. Well, now you have these people that were prop caught in the middle saying, wow, now you took away my exemption, now I'm out there almost on record saying I thought I needed the exemption. And if I needed the exemption, I'm almost admitting I'm a pool, right? Because if I wasn't a pool, I wouldn't have filed the exemption. So that was a tough time for a lot of our clients, advising on whether, were our facts consistent that, yeah, we may have filed the exemption, but it was really to be conservative. We can still go back and say we're not a pool. And so there was a lot of analysis around that. The clearing firms as well, an advantage, obviously, they have to be sure you're not, because under, some of you may know, NFA Bylaw 1101, if a member of the NFA does business with another entity or person that's required to be registered, and they're not, the CFTC and the NFA can hold the member firm liable. So what you saw when this was rescinded is that most of the clearing firms had to be comfortable that their clients had said, oh, we're fine, we'll take the risk, it's not that clear. And then I said, well, it's not necessarily just your decision, you have to get your clearing firm comfortable. And clearing firms, rightfully aren't, there's no reason for them to be aggressive. There's no reason for them to take an aggressive position with their clients because there's not a lot of good that comes from it. So this is a long story to be, if you start to bring in any sort of passive money, you may unwittingly become an advisor. You may become a CPO, you may become a CTA, and you may become, if you're trading equities, an investment advisor. So that's just something I would be careful about, because you're in this nice world of not being regulated, except maybe being a member of an exchange, to a very different world of being regulated. Do you have any other?
No, I think I'm done.
Okay. Well, I think that's probably enough. Any questions from anybody?
Hey Lance, I have a question. So a lot of these trading firms start, everybody has good intentions, you have 2 or 3 people who've been with each other for a long time, and everybody pools capital, and then things go well for a long time, then all of a sudden they don't go so well.
Right.
And is there anything that these traders should be doing to put in their operating agreements where one trader can effectively buy out another trader or dissolve an entity or something like that?
And that's a good point, which we've done in the past, and let me touch on that quickly. The question was, everybody's happy when things go well, and everybody has a problem when things don't go well, and what can you do to address that up front? So it's a great question, and it's one of the bigger pitfalls that a lot of our clients fall into, which is, Phil and I are great friends, and we form a firm. We're never going to have a problem with each other, right? I mean, why do we need to hire an expensive lawyer to figure out what our deal is? We know what our deal is. Phil gets 60% of the profits, I get 40, we're fine. We don't need anything else. And then what you find out is, we do our deal, and Phil's much better than I am at this, and don't really want to work anymore. So I just say, hey, Phil, you just keep going. I'm going to be on the beach. Send me a check. Good luck. And Phil's like, well, that's not the deal we had. We were supposed to both be pulling our weight. You were supposed to do X. I was supposed to do Y. And, I can't be your partner and just give you 40%. So what we typically do for a lot of our clients up front is set the rules of the road in the LLC agreement. And this can get pretty complex. Think of it as a business prenup, which is for all the partners, we set forth what are your expectations, what are your duties, and if you don't abide by those duties, what happens? So let me give an example. Usually when we set up our clients, we say, all right, Phil, what's your role? Okay, let me put that in the agreement. What's my role? Let's get that in the agreement. How do we manage the company? If there's 2 of us, it gets complicated because we're sort of deadlocked. 3 of us, a little easier, usually go by majority, but who controls the firm? Do we have equal vote? Does Phil have, because he's got 60% of the profits, does he have a greater vote? Do we have fiduciary duties to each other? Can I go find a trade that I'm like, this is a really good trade. I'm going to go do this over here because I don't want to give Phil a piece of that. Does that violate our agreement? Do we have non-competes? Phil's a great trade. I have to lock him up because as soon as he figures out I'm not that good, he's going to go trade somewhere else, and I want to make sure that the money I committed isn't for nothing. So I need to lock Phil up with a non-compete. Non-solicits confidentiality. That's all the easy stuff. The hard stuff is, all right, what happens if I don't fulfill my obligations? God forbid, death or disability. Or I just say, I'm walking out, I'm going to resign. What you often see is contracts don't address that situation. So I could, on many contracts, just go walk away, and Phil still owes. Phil has all these duties, meaning he can't go trade somewhere else, and he still has to give me 40% of the profits. So what we usually do is we'll set forth what's called a buy-sell, which is the deal generally for active partners, usually at the beginning of a firm, is we are all bringing something to the table, right? Other than capital. And it's usually we're good traders, I'm a good finance person, whatever it is. If for any reason either of us don't provide services, whether it's due to death, disability, bankruptcy, one of us gets fired for cause, we resign, we need to be able to buy back that equity. Okay, so then the question becomes at what price? And usually the price will be dependent on the reason. So if it's a good reason, like, hey, Phil, I got to resign, or I got to retire, I'm going to give you sufficient notice.
Death or disability.
Death or disability, which is a good reason in the grand scheme of things, but not a really good reason at the time. We're going to have a higher price, right, because it's a reasonable thing. But if Phil fires me for cause, or I walk away, right, not even after a vesting period, I should get a much lower price. And so it's important to set all that up before you even know how valuable the firm is. That's the time to do it. As soon as everybody sees dollars and the firm is doing well, it's much more difficult to get that done because everybody knows what they have at stake. Okay? So doing it right at the beginning, although expensive, will save you a lot of money in the long run because one lawsuit, and I think out of all the lawsuits we see in connection with trading firms, two of the main ones, non-competes obviously, but partner disputes. And those lawsuits will go on forever because there's a lot of money at stake. So spending the money up front and having the rules of the road and then hopefully never even looking at it again is the thing to do.
I'd like to talk about another situation that we've seen in the last couple of years, and I'm sure Lance has too. That think about a trading entity that you become what I'll call a Class B member, and you're compensated based on eat what you kill. So let's say, for example, that you're getting 80% of the profit, and you're basically putting your money up on a trade, and if it's a Merck member, it's at least $250. Some other trader in the firm blows up and basically goes through his capital. Well, then your capital is at risk. And we've seen this a few times where this Class B member of a trading LLC will say, well, gee, I didn't lose any money. Why should my money be at risk? And we explain to folks very clearly, when you put your money in this firm, it's at risk of other traders if that trader goes out through all of his capital. And I'm sure our Advantage friends can tell you, they look at a trading firm as one entity. They don't look at it as 10 different capital accounts or 10 different traders or 10 different entities. Their credit risk is the entity in total.
Yeah, they could care less what your document says about what each trade is liable for. Almost universally, all the money is at risk.
Where does that 250K classified
The
like
250 is capital. It's capital. It's equity. In order to comply with CME rules, it's equity. But let's assume I put 250 up and I'm on a 50-50 deal, but I lose $1 million. I'm still theoretically owed 250, and I'm not obligated to put more money in, which means the rest of that is being eaten by the firm. Because to Advantage, it's $1 million loss, and they're going to take the $1 million because they've got a margin in the account or they have whatever guarantee, and they're going to leave it to the firm to allocate where that loss goes to, but they're going to be indifferent as to where the money is. But yeah, the 250 is equity. And a lot of people just, think, oh, well, can I put 250 up as a security deposit for a 1099 out equity? That will violate CME rules. If people are putting money up, it needs to be K1, and then you need to follow the rules. You can't sort of be in this hybrid land where it's, oh, pay me as a 1099, but I have money up just in case to secure a debit. That'll violate CME rules. You see that more in the equities world. That'll violate CME rules. Any other questions?
Can you just give a quick example, like a simplistic example on the 60-40 rule with, like $100,000, you made $100,000, your expenses were like $20,000.
Phil can definitely do that.
Okay. Again, go back to the two pots. 60,000 goes into the long-term pot.
Right.
If you made $100,000, you're being taxed at 15% on that. The 40,000 is short-term. Assuming you have no other short-term gains or losses, your $20,000 in expenses offset that 40,000. And you would take those if you're an individual trader on Schedule C.
Okay.
So the simplistic lawyer view is, so Phil, what you're saying is I'm left with all long-term cap gains.
Yes.
So usually most trading firms, if they, they bring in their 60/40, and as Phil said, they have a bunch of ordinary expenses, it's better than the blended rate. Because by the time you net off all the ordinary expense against the short term, you're left with all long term, which is why, as Phil said, it's the best deal of any industry, because you can get long-term gains trading in microseconds.
It gets better. Let's say you're a you're a partner in a very large trading firm. Your ordinary expenses are greater than your short term. So now the excess of the ordinary expenses over the short-term capital gains, or the 40%, is offsetting your ordinary income from all types of other businesses. So you're basically converting ordinary income to long-term capital gains.
See, but that's, he mentioned being or you mentioned being an individual trader. That's still assuming that the IRS is recognizing you as a trader, not an investor. You still have to meet that minimum. So he could be trading, not an LLC as an individual trader, but he still has to meet minimum trades to be considered.
He does. He does, but as I was looking at this most recent tax case, where the tax court said, gee, you only traded 500 times this a particular year. I think about some of our high-frequency clients, and I'm thinking, 500 trades, that's a slow day for them.
Slow hour, actually.
And what was the change introduced by Obamacare?
So what did you say, when?
What?
So basically, let me say generally, and then Phil will go into detail. It used to be that you pay self-employment taxes, right? So self-employment taxes, without getting too complicated, the big piece that you used to not be able to cap was the Medicare. It was what, 2.9?
Yes.
It was 2.9. So you would have 15.3-ish?
Up to 118,000.
Right, so you have 15.3 up to 118,000, and people didn't worry as much about that. They worried that after you got over that, the 2.9 was uncapped. So if you made way over that, you're still paying 2.9. And so people used to set up structures to limit the amount of the 2.9. When Obamacare, and let me back up, and that was partially, are you active or are you a limited partner? If you were a limited partner, then you weren't subject to self-employment on your income. So people would set up elaborate structures where part of it was for active, the other part was a limited partner, and as long as the compensation was reasonable, people would protect the lion's share of their profits on the 2.9. Obamacare wiped all that out, and basically, what is it, 3.8 on investment income?
It is.
So they just
It's
charge
either
it.
3.8 on investment income, or 3.8% is Medicare.
And they
so
don't
either
care,
way,
right.
you're paying the 3.8%.
And so no longer do they care whether you're active. It's just if it's investment income, which what you guys do is, you're automatically hit with that 3.8. And there's no, even if I have 50 companies shielding it, there's no way to protect it because it looks at the character of the income as opposed to active versus passive.
Thank you.
Sure.
I guess I have like a legal question kind of. I'm an options trader, and let's just say I've got a large portfolio of options on
You futures options or equity options?
futures.
Okay.
And as time goes by, I start seeing some things developing, that I really want to trade, but I don't have the excess capital in order to do so.
Mm-hmm.
Other investment entities have wanted to invest with me for a while. How do I bring in additional funding, assuming I want to take advantage of some international opportunities, but not affect my book, so to speak, or my position?
Mm-hmm.
Can I sell shares under an LLC to potential investors while still maintaining, my individual?
So you're saying I want to basically, I'm trading this,
Right.
it's all mine, I want to expand to other arenas and I only want to take capital in and share it with that, but I want to keep this for myself?
Right, but I want to. But let's just say I'm still trading like I'm trading the same product, but I also want to incorporate other products.
Well, let me say it simply, and putting aside the advisor issue that we talked about. From an LLC and tax perspective, you can create classes, and that's what we're talking about, of an LLC that says, hey, you want to put money in our firm, but you're only going to take this book, we can create a class that only tracks to the P&L on that book, so that if you're the investor, Phil and I keep this book, and you only participate on this book. So from an LLC perspective and a tax perspective, you can do that. What you have to then solve are, do you have a CME issue? And by taking that money, are you now potentially an advisor? But if you're asking me, is it doable? It's doable.
And your investors would still be subject to the 60/40, assuming they're U.S. entities. If they were foreign entities, then they would be exempt from.
Because if you think about that, in most of the sort of so-called eat what you kill situations where I'm going to put $250 in, that's exactly what you're doing. It's the same thing, which is I'm only getting a piece of my proprietary trading account, and there's all this other trading that you're not allocating me. That concept isn't really any different than what you just proposed. You're just sort of doing it with a passive versus an active. So other than the regulatory issues, that accounting, tax, and legal is really the same thing as an eat what you kill deal. It's just reversed. All right, well, thank you guys for coming. Any other questions? We'll be around for a couple minutes.
Thank you.
Thank you.